Good afternoon. Thank you for joining us for this month's webinar regarding the psychology of investing and how to keep calm in the event of market turbulence. My name is Jenny Dunberg, and I am the Marketing Director here at Biltmore Capital. We all know that fear is one of the biggest driving factors in the human decision-making process. And during market volatility, there is definitely a lot of that fear of the unknown, which can make investors take action for the wrong reasons. Not saying that you shouldn't listen to your emotions, but this webinar will point out the important investment behaviors that have proven successful over time to position yourself so you feel more confident when market volatility does show its face. Today, we have Mark Peterson joining us from BlackRock. He is a director in the Advisor Insights team at BlackRock and is focused on investment strategy and education. He is a 25-year industry veteran with extensive expertise and experience educating investors on market and investment topics. Thank you so much, Mark, for joining us today. And with that, I will let you take it from here.
Hey, Jenny, can you hear me?
I can hear you.
Okay, I lost you there for a minute, but thanks for having me on the call today. Good afternoon, everybody. We're going to talk a little bit of psychology of investing and a topic we think is very timely and very timeless, right? Certainly always important, but I think especially given everything we've gone through here the last 18 months, certainly something that I think has been heightened given all the challenges that we faced probably last year in general. We'll look back and when the dust settles and we'll say it was one of the toughest years ever for a lot of things, including this psychology of investing. And Jenny hit it on the head. That really this topic looks at some of the pitfalls folks fall into on a regular basis when they think about money, when they think about investing. It really does fall into a certain pattern in most cases. So this is something that we'll highlight throughout the presentation. We have a handful of slides for you. I'm kind of a chart and graph guy, so I couldn't help myself. So we'll have some charts and graphs in there as well. But you know, something that I think hopefully everybody will find extremely useful and really push the ball forward on how you think about investing. That's really the main goal. So if we just jump into this topic in general and look at, you know, just the importance of the topic, you know, I've hit some of that already. You know, when you think about what makes a successful investment plan, you probably think about the portfolio, right? What you actually own, the securities you own, you know, some other things on the edges might also come up, right? Like estate and tax planning, all those things are all kind of tied together. But when we talk about what makes a good successful investment plan, it really starts with the investor behavior at the bottom. It's really the foundation of any good successful investment plan is what we call investor behavior. And this is your ability to stick with the investment plan, right? To make sure you keep your plan on track. Don't let it get derailed for whatever reason. That's the foundation of what makes a successful investment plan. It's not what the portfolio looks like, right? You could have the best portfolio in the world, even though that portfolio never exists. But if you're not in the market or if you do something to take that plan and that portfolio off track, everything else really crumbles around it. So that's what we'll touch on today. I think, you know, another quote that's so important, or at least a quote that's so important is from Warren Buffett, a pretty good investor in his own rights. He said, we don't have to be smarter than the rest. We just have to be more disciplined than the rest. And that's what we'll touch on throughout the rest of the presentation. We'll talk a lot about that discipline. I think it's always critical when we think about keeping your plan on track is being able to employ some of that discipline. And it's not about being the smartest person in the room. I think sometimes we confuse it, you know, great investors with the smartest folks. But as Warren points out here, right, it's really about being disciplined and employing that discipline. And discipline can come about in a lot of different ways. A lot of times it's purely through education, right? We can just educate ourselves better about investing in the markets and portfolios. That's certainly a piece, and we'll touch on some of that. But some of it is just also understanding some of the basics of some ideas that we'll share from some of the investment teams and investors we work with across the country. So what we'll do the rest of the way, we'll talk about two of the key emotions where we see most of the behavioral challenges, right? We'll talk about envy and loss, kind of two extreme emotions on two ends of the spectrum. And then we'll talk about building in some of that discipline more directly, again, some of those best practices we hear from folks across the country. So let's start with envy. And I apologize. This is the best picture I could come up with for envy is a fishing hook with a $20 bill through it. But we'll talk a lot about envy and regret. Envy and regret, I think, are really interesting emotions, and something that we deal with in all of our lives, right, in different ways. And envy and regret, when you really think about it, regret, we should only regret bad outcomes, right? But too often times we regret what could have been, right? It's the old millennials call it FOMO, right? The fear of missing out. And that's all about envy and regret, right? We could have had a situation where the outcome wasn't bad, but we still regret our decision makings or some of our actions, because if we would have done things differently, maybe the outcome would have been even better. And that oftentimes, right, that envy and regret can be really damaging to future decision making, because it can paralyze you, right? You're thinking, oh, I'm just going to make sure I do everything right so I maximize the outcome. So that envy and regret can be really damaging in a lot of ways in our lives. And one great example of this envy and regret is around the Olympics. And we just had the Olympics, right? So we can all relate to this probably a little bit more. And they do this study every time the Olympics rolls around, and the results are always the same. Doesn't matter the country or the year of the Olympics or where the athlete's from. It's always the same results. And they look at the happiness of the medal winner on the podium. Believe it or not, somebody actually studies that. But it's a great behavioral study for this envy and regret. And they notice that the bronze medal winner is almost 1.5 times as happy as the silver medalist. So that gold medal winner is the happiest. We throw them off the slide. That's not that interesting. But the bronze medal winner, 1.5 times as happy as the silver medalist. Think about why that would be. Right. I think we can all probably guess, right? That bronze medal winners just happy to be there, right? They're just happy to be there. They know they were probably just as close to fourth place, right, in the Olympics. And I'm not sure exactly what you get for fourth place in the Olympics, but I know it's not a medal. And I know it's not being on the podium and getting your country's flag raised in your honor. So a big drop off. And there you just get that happy to be there mentality with that bronze medal winner versus the silver medalist. Think about that silver medalist for a minute. They're thinking about what they could have done differently to make up those fraction of inches or those fraction of seconds that was probably the difference between them and winning that gold medal, right? That lifelong dream of winning that gold medal in the Olympics. They're riddled with that emotion on the podium. And it really is damaging to their overall experience, right? They're regretting different things they could have done, and they don't have as good of experience as actually that bronze medal winner. So great example of this regret and envy emotion that we naturally always have in our lives. Think about other situations where it pops up, right? And one area that we see it pop up in investing is when we think about a diversified portfolio. A diversified portfolio, in this case, we're using 60% stock, 40% bond portfolio. I know everybody will have something a little bit different based on where you're at in your investing life cycle and your risk tolerance and all those good things. But look at this diversified portfolio versus the US stock market over the last 20 plus years through various market cycles. We always joke that with folks that, you have a really well diversified portfolio if it never feels good, right? If it never feels good, you probably got a pretty good mix of asset classes, because you get this emotional dynamic going where you still lose money in a difficult market, right? That never feels good. Look at 2008 in this example. That 60-40 portfolio, that diversified portfolio, lost almost 25% in one calendar year, right? That never feels good. You can't hide that on a statement anywhere. And then on the other side, when the bull market returns, look at that 2009 to 2019 period. You lost, or you made 195%, but you left 150%, over 150% of the upside of the US stock market on the table, right? The fact that you trailed, you didn't make as much, doesn't feel so good either. You get some of that regret and envy going, especially at that cycle, that part of the cycle. It was amazing how many folks we had during that period that were wondering, right, if their portfolio still made sense, if they should do something different, right, if they're not capturing enough of the upside. So this is a natural, right, emotion. This envy and regret is really, really riddled throughout these investment cycles, right? When you lose money, you regret that you invested at all, right? And when you don't make as much money, you start to question your portfolio. Of course, the punchline here with my fancy animation is that the diversified portfolio, if you add up this 20-year stretch, the diversified portfolio actually ends up ahead, right? And actually does so with a heck of a lot less risk and a heck of a lot less volatility and drawdown of your initial dollars invested during those difficult markets. So I think it's a really important reminder on why we build portfolios the way we do, right? Why we asset allocate, why we diversify, why we spread your investment eggs across a variety of investment baskets. It's all to get to this dynamic, right? What we call at BlackRock, winning more by losing less. Winning more by losing less. You don't need all the upside of what the good bull market brings. If your portfolio does a better job, especially in those difficult periods, that's what matters most. That's what actually impacts your outcome more at the end of the day. It's just tough to see because emotionally, right, that envy and regret throughout the investment and market cycles can really cloud that, right? We just caught up in whatever period we're in at the moment, right? Whether it's losing money, right, it's certainly difficult, or even some of those bull markets are probably just as challenging because they can last 11 years, like 2009 to 2019. And you think they go up forever and you get a lot of complacency and you get riddled with that envy and regret is so natural. So I think it's a great reminder, right, that how damaging this envy and regret can be. Often folks drives folks to do something that they shouldn't, and certainly something they shouldn't do at the wrong time. And think about this 20-year stretch, by the way. I was talking with somebody internally about it the other day. Look at this 20-year stretch and how well this diversified portfolio held up, right? Think about the events that went on, right? 2000, 2002, you had the tech bubble bursting, you had 9/11, right? You had the global financial crisis in 2008, 2009. You had the longest US economic expansion in here as well. That 2009 to 2019 was the longest economic expansion we've ever seen. Wasn't the best, but it was the longest from a time period standpoint. And then you throw the global pandemic on top as kind of the cherry on top. Pretty historic period in markets and in our economy. And look at how well the diversified portfolio held up. I don't think we talk about this enough, right, as an industry. And it's a great reminder, again, why we build portfolios the way we do, right? It's not about getting all the upside. It's about doing a better job in the downside. That gets you to that winning more by losing less story. It's just hard to see because the envy and regret that's so natural. And let's talk a little bit more about that winning more by losing less. This is probably more educational than behavioral, but there's certainly an aspect of the investment math that is behavioral that we just forget about the investment math of that winning more by losing less story. And they probably tell you no, never do math on a webinar, but we'll give it a shot here because I think it's super important is just to understand that if you start with $1, you lose 50%, you're down to 50 cents, right? Your value's cut in half. Your dollar goes to 50 cents. You see that in the gray box. So if you were to be up, what would you have to be up next year just to get back to break even, right? Think about it for a minute. What do you have to be up from a percentage standpoint to get back to break even? And the answer is 100%, right? Doesn't matter how much you start with, could be $1, could be $1 million. The percentages are the same, right? If you're down 50%, you've got to be up 100% the next year just to get back to break even. That's how the investment math works. But look on the bottom as we build out the charts. Think about that 10% number, that minus 10%. What do you have to be up if you're only down 10%? What do you have to get up? What do you have to be up the next year just to get back to break even? It's only 11%, and 11.11111 is the exact math for those math geeks out there. Look what happens as we build out these bar charts on the bottom. Look at how the combinations change. The farther we move to the right, the farther we get into that lost territory, the more the math bends against us, right? Look at that minus 60. So just one step out from that minus 50 combination that we touched on. Look at minus 60. Now, all of a sudden, you've got to be up 150% just to get back to break even, right? This is how the investment math works. I think, again, behaviorally, we probably all learned this at some point, right? We've just forgot it along the way. And it's just it's why that winning more by losing less story works, right? It's not just a catchy phrase, winning more by losing less. It's really how the investment math works behind the scenes, right? If we limit the loss, we don't need to be up as much to get back to break even. We don't impair the portfolio with massive losses that can really derail an overall investment plan and investing success. So for us, just a good educational reminder, right? Why that winning more by losing less is so important. It's just easy to forget because of that envy and regret that's so natural, especially with that well-diversified portfolio. So let's move on to loss. And loss is a fascinating emotion, probably the most studied emotion within the psychology of investing field. They've done a lot of work understanding how folks deal with loss when it comes to money and investing. And what they found is fascinating, probably one of the pillars of this field of study. And they found that losses feel more than twice as bad as gains feel good. So think about that for a minute. Losses feel more than twice as bad as gains feel good. I think we could probably all relate to that in some ways, right? And certainly for some folks, it's even worse than that. But it's an important pillar of this loss emotion, is to understand that losses can really make you do a lot of irrational things because it naturally feels worse than gains feel good. And one of the things that it does, and like clockwork, it always does this when we see this loss emotion get revved up with our clients across the country, is it creates some tendency towards action, right? It creates folks just want to do something with their portfolio. It's such a natural reaction, right? You don't want to just sit there and take your lumps, right? And this is another study. This is actually another sports related study. So nothing to do with the markets and the economy, but it looks at the tendency towards action that we all naturally have as humans. And this tendency towards action can be overwhelming, especially in a highly pressurized situation. And this example looks at soccer, or I guess they call it football, right, in Europe. And it looks at the penalty kick. And I don't know if you know what the penalty kick is, but the penalty kick is used at the end of matches to decide a tie match, right? Which happens a lot in soccer, a lot of low scoring matches. And it's just the goalie against the kicker one-on-one. So the goalie against the kicker one-on-one, and it's really tough on the goalie because the goal is huge in soccer, right? I think it's about 14 yards wide. The kicker's only about 12 yards away. So the goalie has little to no chance if the ball is struck properly, right? They won't have time to react and try to stop the ball. So they've done a lot of studies, and they found the best thing the goalie should do is just sit in the middle, right? Just sit in the middle, do nothing, and wait for a ball that's not struck properly and react to that. Yet what they actually find out, even though all the goalies know they should just sit there, that's what all the studies tell them, the goalies can't help themselves. They jump left or right before the ball's kicked 94% of the time. They're overwhelmed by this tendency towards action. They don't want to let their team down. They don't want to let their country down. They pick a direction left or right, and like clockwork, try to anticipate where the ball is going. And they found the best place for the kicker to kick the ball actually is kick it center middle where the goalie's head starts, because they're never going to be there, right? You'll score 80+% of the time if you kick it center middle. And I think that's fascinating example of this tendency towards action, especially when we're in a highly pressurized situation, right? We don't want to just sit there and take our lumps. And it happens in other areas in our lives. Think about so many things, right? If the car breaks down, we naturally need to take it into the shop to get it fixed, right? It's not going to fix itself. And it's a positive outcome and reaction in a lot of cases in our lives. But there are situations where doing something isn't the best action, right? And we see that a ton in the investing world, right? And it's really tough sometimes to sit there and do nothing and let time in the market really play out. I'm sure we've all heard that market adage versus trying to time the market. And this is something we saw so much last year, right? It's such a natural feeling after we have some of the worst days in stock market history to think that, hey, if I would have just missed that worst day when the market was down 10%, think about how much better my portfolio would have been, right? If I just wasn't invested during some of those worst days last March. We actually had 3 of the worst days in stock market history last March. Think about that. 3 of the worst 15 since 1950 last March. The problem is when you have some of these worst days, they're always surrounded by the best days, right? So we had 3 of the worst last March, but we had 5 of the best 15 days in stock market history since 1950 in March and April last year. So what naturally happens when folks try to time the market is they miss some of these best days in stock market history. And look at what happens to your outcome. If you just miss some of these best days, if you miss the best 5, right, 100,000 would have grown to over 400,000 if you just stayed invested over this 20-year stretch. But if you miss the best 5 days over the last 20 years, right, 3 of them were last year, last March, look at what happens to your outcome, right? Significantly lower, right? Not just by a handful of dollars, right? You're talking $150,000. If you miss the best 15, right, you're almost back to break even. If you're super unlucky and you miss the best 25 days over this 20-year stretch, you've actually lost money at that point. That's the challenge with trying to time the market. It's all driven by this loss emotion, right? Losses feel twice as bad as gains feel good. That loss emotion gets revved up. It's natural. You want to do something to your portfolio, but history tells us that the best thing to do oftentimes is let the time in the market play out and work for your portfolio over time, not try to time the market, because inevitably those worst days are surrounded by those best days. They sit and they live in the same neighborhood. And we saw that last year, a perfect example of that playing out over time. There were a ton of folks who got out of the market in March and April of last year and have missed most of this rally. We have record amounts of dollars on the sidelines right now. Still, there was a study last year done industry-wide that folks have embraced that looks at 1/3 of retirees sold some portion of their stock portfolio in March and April of last year and missed out on a good part of the rally that we've seen since. So this is a really an important area where we probably see the most mistakes in investing in portfolio dynamics is folks get caught up in that loss emotion getting revved up. You get the tendency towards action kicks in. It naturally leads you to try to time the market in some way, right? Where you just try to say, okay, I'm just going to move even a portion of my portfolio out. You can see on this slide how damaging that can be over time. So that's that loss emotion. And that tendency towards action critical, right? Lots of mistakes in that area. Let's finish up now and talk about building in some of that discipline. I think first off, you need to acknowledge that, right, this is an area that we don't talk enough about as an industry, that use your financial advisors that check and balance emotionally, right? Not only can they be the source of education, which will help build up that discipline, but they can also be in that emotional check and balance for you. When you do get that loss emotion revved up, or when envy and regret really starts to dominate your thinking, either extreme, right? Your advisor can be that check and balance. And even us as professionals in the industry, we talk to each other about our emotions and keep them in balance. I can tell you at BlackRock, our best investors, our portfolio managers who run some of our mutual funds, they actually have a behavioral coach that they work with within our risk group. Because even the best and brightest and most experienced investors, they're not immune to some of these behavioral challenges. Granted, they're different as experienced investors, but we've found that having a check and balance is a great way to make sure you're not losing out on performance. That's really what we're talking about at the end of the day, right? Is you don't want to lose performance. You don't want to lose and impact the outcome of your overall investment plan by doing the wrong thing or doing something at the wrong time because of your emotions. And one thing we've heard that really builds on this idea of leaning on your advisor to be that check and balance is something that's pretty simple. And I'm sure a lot of you are already doing it with Jenny and team. But to think about what you're going to do when the market does go down 20, 30, 40%, right? Next year, next quarter even, right? What are you going to do? And always talk about that bear market plan every time you talk with your advisor. And regardless of where we're at in the market cycle, right? Don't wait for it to happen, because often 30, 40% to talk about what you're going to do, your emotions will be overwhelming and completely cloud your thinking in the heat of the moment. What we've heard from investors is one of the best things you can do is consistently revisit that bear market plan at each point of what can feel like the emotional roller coaster, right? Talk about it when the market's doing great, like it has the last, right, year plus. Talk about what are we going to do if the market's down 20, 30, 40%? Are we going to rebalance from bonds to stocks that take advantage of cheaper prices? Are we going to increase contributions to certain savings vehicles that we still might have access to, right? I know I did that some of last year, right? Increased contributions to 529 college savings plan when the market was down, right? 30%. Certainly made some sense to take advantage of stocks at cheaper prices. Or maybe it's repositioning a portfolio and take advantage of tax losses, right? Make your accountant happy and reposition the portfolios for some of that. That's certainly something that can be productive in a downturn. But have that plan in place, revisit it, because what we've heard from folks is a great way to neutralize those emotions at each point of the cycle, especially once you get into the heat of the moment when the market's actually down, because you can say, hey, remember, we talked about what we're going to do, and you were on board when the market was up and doing great. Now we've got to have the courage to do the right thing and rebalance or increase contributions or whatever the action plan might be to actually do that when the market's down. We've heard this is just a great way, just a subtle tweak on probably what you're doing, but a great way to neutralize those emotions across this emotional roller coaster ride. The other big thing, and this is probably in my 25 plus year career in the industry, this is probably bigger than ever, is we need to turn down the press and the news as much as possible. The news today has evolved and changed from where it was 25 years ago. It is an enemy of investor discipline today, more so than I've ever seen before. News is so polarized, certainly more political than ever. It really is trying to get ratings and viewership and eyeballs and clicks on the internet, right? You have so many different sources versus the past that they're all competitive with each other. They're trying to get those ratings and eyeballs and clicks. So they tend to really appeal to the extremes in a lot of cases. And a lot of times those headlines tend to be so much more dramatic, the content tends to be so much more sensational than we saw 20, 25 years ago. So this is something I always try to highlight with folks, that especially when we're quarantined at home, right? It's always additionally difficult, but try to filter through some of those news sources and understand how it can be an enemy of your investing discipline. Because it's amazing how many stories that we can tell you. We got calls from folks last year that read an article, right? Especially last year was super easy to do, given the pandemic and the shutdowns and all the challenges that we went through last year and still going through to some degree today, right? That they read an article or they heard somebody on TV or heard about a story from a neighbor, right? We need to filter through this as much as possible because it is an enemy to our discipline. And one of the things that we see most on financial TV news, right? If you watch some of those financial TV news channels, is they'll make predictions. They love making predictions. Predictions are really for weathermen. We probably shouldn't do it in our industry, but it makes for good TV and makes for good ratings, right? Where they'll make some prediction about the economy, or they'll make a prediction about the market, right? And this is a study that we did, actually looking at how often financial professionals get the direction of interest rates right. So just, are interest rates going to go up or down from today to next year? Are they going to go up or down? And interest rates never stay the same, so they always go one direction or the other. So the coin gets this right half the time. You just flip the coin, you get it right half the time. Yet the Wall Street experts over the last 20 plus year period here that we looked at only get it right 43% of the time. So they're worse than the coin in getting the direction of interest rates right. And this is known as the forecasting folly within the behavioral and psychology worlds, and also known as the expert fallacy, which I think we can all relate to, where we can be an expert on the markets and portfolios, and we can have a pretty good idea on what stock and bond and what portfolio returns are going to look like over the long term, right? Over the next 5-10 years. But it doesn't mean we can predict things in the very short term, right? The next 6 months, even the next 12 months becomes very difficult to do. And this is, again, is known as the forecasting folly and the expert fallacy, right? That we just can't have short-term predictive abilities. I think we've seen that in other areas other than just finance, right? Certainly with the pandemic, I think we've seen that play out as well. And this is what one of the famous philosophers from from the New York Yankees, Yogi Berra, famously said, "It's tough to make predictions, especially about the future." I think really captures what we're getting to here. But challenging, I know, but try to filter through some of these news sources, especially these forecasts. They're just a pure enemy of investing discipline over time. So I think I'm out of charts, believe it or not. Hopefully that was helpful. Think about where we started, right? Just the fact that the foundation of any good successful investment plan is this ability to keep things on track, right? Don't let your emotions sink into your decision making, right? It's the foundation. Without it, everything else crumbles, right? Doesn't matter how good of a portfolio Jenny and team have built for you. If you don't stick with it, everything else crumbles. And it's all because some of these emotions that we touched on, right? Think about envy and loss, right? Think of that silver medalist that we touched on, right? Just naturally to have that regret and envy, especially through the various market and economic cycles, right? Remember that winning more by losing less, right? We don't need all the upside if we do a better job of the downside. Remember that math quiz, right? Ask your friends, see if they know the math. I'm sure some of them do, but most of them probably don't. It's the key to that winning more by losing less story. We just lose sight of it because of that envy and regret that's so natural. And then that loss emotion on the other side, right? Remember, losses feel twice as bad as gains feel good, right? And you get that loss emotion revved up. Of course, what kicks in is the tendency to do something, right? That tendency towards action, right? We want to do something and not just take our lumps. So naturally, when it comes to investing, what we do is we try to time the market. And we could miss some of those best days, right? If we move out following some of those worst days, we're going to miss some of those best days on the other side, because those best and worst days sit right on top of each other. Don't underestimate that. Watch it play out next time around, right? It's natural. Guaranteed it'll play out whenever the market's volatile. Just make sure you understand how all these things are connected, right? Loss emotion, tendency towards action, trying to time the market. They're all connected with each other. And then finally, right, think about what we can do to build in that discipline. Education is a big piece. Some tricks of the trade as well, right? Lean on your advisor, let them be the check and balance along with that that educational resource, right? Even the best folks at BlackRock have an emotional coach that they work with to try to limit those things, because at the end of the day, it's performance. And certainly think about what you'll do, right? That bear market plan, talk with your advisor about that. Don't just wait to get into the heat of the moment, right? Have that plan in place. Great way to neutralize those emotions and turn down the news when possible, right? I know that's tough in today's world, but it's an enemy to your investor discipline. At least understand that. And we think all these things will help you become a better investor down the line. And most importantly, save your emotions for the moments that really matter, right? The friends, the family, the loved ones. I think certainly something we can all relate to here over the last 18 months, right? That's where your emotions belong. They don't belong in your investment thinking or your investment planning. So that's it, Jenny. Hopefully that was helpful. I'm certainly available to stick around here if you have any other comments, thoughts, or questions out there. Love to hear what's on folks' minds, even beyond this topic, just on the market in general as well.
Thank you very much, Mark. We really appreciate you taking the time to present today and bring these things to our attention. Again, when markets get turbulent, it's super important for you to discuss your concerns with your financial advisor to reassure that you're sticking to your plan and staying disciplined and not changing that plan when your emotions do rise. So we really hope you enjoyed today's presentation, and we look forward to seeing you next time. Hope you have a wonderful rest of the day.
Thanks, everybody. Thanks, Jenny.
Bye-bye.